Welcome back to the Talking Hedges 8-part cannabis business plan. You made it all the way through. This is part 8. We started with part 1. That was how to develop the ideal team. We moved on to part 2. That's how to target who you're going to sell to. Finally, what you're going to sell and how much. Part 4 was about investing, equity or debt. Part 5 was putting your pitch deck together. 6 was about automation, scaling, expanding. Part 7 was the island of opportunity of Puerto Rico. And now we're on part 8. This is about partnerships, mergers and acquisitions, and exit strategies. Strap on your seatbelts. Class is in session.
It's only entertainment.
Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business podcast.
If you haven't already created an exit strategy, it's sort of working backwards. You're not going to be in this industry forever. So anybody who thinks that they're going to be a legacy and be in an emerging market like this, you're out of your mind. You don't have the scale, you don't have the manpower, you don't have the money, you don't have any of it. You're just not going to be around. And so you need an exit strategy, use that money, and then come back when there's more opportunities. Like when there's a time for craft cannabis, when there's a time for alternative. Right now, this is just big conglomerates coming out and you're not going to survive. So best to get in, first mover advantages, get some money, get out, think about an exit strategy. That is mergers and acquisitions. You're going to be acquired whether you want to or not. Capitulation is forced consolidation. That's going to happen. Best to have a strategic partnership, create some co-op models, things of that nature. Basically, right now, kind of going to go into what some of the trends are when you're in this space and you are going to be acquired or you're looking to acquire somebody else. What does that merger look like? What are the opportunities? How do you create a partnership? And ultimately, what does the exit strategy look like? We're going to run through all of that stuff, starting with just the basic mergers and acquisitions investment trends. You're starting to see a lot of investment in cultivation and retail. The missing sector in between is the manufacturing. You have producers, you have processors, you have retailers. That's the vertical integration. Of course, you have delivery and ancillary outside of that. But right now, investment in cultivation and retail is accounting for about 60% of 2021 deals. Includes over $6 billion worth of deal flow. Investors are looking specifically at like technology. They want to see a lot of the information on the back end. So there's been repeatable business. It's these multi-state operators going in and have redundancies and buying the same thing over and over and over again. But when there is cross-state legalization, you're not going to have that. In the meantime, a lot of these people are kind of wasting their money. So it's best that you come in at a local level, build it up for them, and sell it. There's a huge chance you might sell to a Canadian company. They have a lot of capital having gone with the public markets in a federally legal environment up in Canada. So they've got their own global emerging market. There's a $500 billion opportunity for them to kind of come down for these private American companies and acquire them at much lower valuations because you don't have that stupid speculation that you see in some of the penny stocks or even in Canada right now. A lot of these companies are incredibly overvalued, and we're seeing some of those multiples come down from 15x down to even lower, around 9.5, 10x. It's not just the stock prices. Valuation multiples have been trending downwards too. So if you're looking at a conservative discounted cash flow model for your valuation, rather than picking an arbitrary $420 million valuation, you need to understand that some of these analysts are looking at 2023 projections. What they do is they'll take a look at your enterprise value to your multiples. That is going to be closer to historic norms, around 10x. It used to be, just back in the day, simple 10x of your revenues is what somebody would buy you out at. So if you want to take 10 years worth of revenue, take that and run. And now the speculation of 15x has come down to 10x. We're kind of seeing that. So that drifting lower of that 15x is despite the cannabis industry seeing improved profitability, improved cash generation. There's access to both debt and equity markets now in single digits. You can borrow money for like 8% instead of 40. There's strong cash positions. I've seen zero debt from a lot of folks in the industry. Maramed, publicly traded company. some other folks out there too, scaling operations, buying people. And even though there's legalization, we don't know what the timetable is, but even aside from all of that, you're still seeing prices come down. So a lot of that speculation is kind of coming down, and you're starting to see that these companies like Tilray are struggling, Hexo is struggling, Canopy is struggling, and these people who think like high prices are going to remain everywhere, $2,000-3,000 pounds, or some folks think they're going to get $7,000 a pound is crazy. Just take a look around. $500 is what you should be putting in your pitch deck per pound, and that's going to be, if you can still remain profitable at that, great. If not, when people from Peru and Colombia and Chile come in at 15 cents per gram with landing costs, you're toast. Canada is definitely out of the picture. There's no way they're going to be able to compete at $6 a gram. So how do you survive? How do you pivot to stay relevant? Find some partnerships. If you're only a retailer, find somebody else who's a producer processor. Try to work with them if it's legal, if you're able to, and max out on the number of locations you can have. If you're a retailer, get 3 locations if you can. If you're in the Northeast, if you're on the West Coast, get 6 locations if you can. If you're producing, keep on trying to find other places and other regions, other states to get your genetics out there, get your name out there, get your brand out there, and become somebody that is in the spotlight to be acquired. Because if you sit around and think you're going to be a Larry's Handy Mart in a world of 7-Elevens, it's not going to happen. The people won't end up trusting that little store over the expectation. They know what to expect in a 7-Eleven. Consistency, pricing at a scalable rate. You're not going to be able to compete. You're not going to be able to compete at that scale. So just take your money, first mover advantages, and do something else. Come in at craft cannabis at a later date when that's an available opportunity. But you should find strategic partnerships. You should try to get out of your comfort zone, out of your area, and start really, really thinking about exit strategies so that you can merge with somebody else and be acquired rather than capitulate, just fold. Here's some examples of what you might look for or expect to see if or when you're in that position to be acquired. Just recently saw 4 M&A transactions that closed this week for a total transaction amount of 165 compared to just 10 transactions for 400 million the prior year. All of those were public companies. So you have stupid money coming in, public companies, and buying it up. These aren't like private companies giving just stock deals or whatever. Year to date, mergers and acquisition volume is up almost 8% versus last year, with 3.2 billion in consideration and 62 deals that have closed. U.S. transactions have been a little bit weaker, with the total consideration down 3%. The average transaction size being 54 million is up by 63%, expected to grow considerably. There's a lot more public companies and transactions out there. A lot of the folks that are being acquired is cultivation and retail. You see some biotech and pharma, some real estate, but mostly what you're seeing is a lot of cultivation and retail. I think if you have a tech company and you have a lot of clients, that's worth some money as well. So I would put that we're seeing a lot of times, not this particular report, but many times we're seeing a lot of tech companies, not so much ancillary, but there is a big play on retail. I would kind of expect retail to cool off, being that commercial real estate is the highest price it's been ever in history. And so somebody like IIPR that goes out and does sale leaseback options is probably at a position where they might not do very well if or when federal legalization happens. And then all of a sudden, that exclusivity on real estate doesn't have that premium anymore, and these prices come way down. So that's something I would look at as just a decrease in overall transactions and pricing and everything. If you do want to stick around longer and you don't want to be bought or go out and acquire, I think the co-op model is the only way you're going to be able to stick around long term. So find a partner, find people that are around, and be big enough to where you aren't going to be acquired. So that's kind of the unionizing that we're seeing right now, is power to the people with numbers. Unionizing is the only way to do that. If you're not going to unionize, you probably won't, then do a co-op model and collaborate with other folks. So you still have your autonomy, your independence, your own business, but you're a part of a group, a larger entity than just yourself. I think that's a way to survive, pivot to stay relevant, whatever. Without that, though, you're never going to be able to scale and compete with the prices that are going to be coming around the corner. So if you don't have literally the best cultivars, the best strain, then look at an exit strategy. If you're not the best of the best, then utilize your first mover advantages and then come back at another time when you can provide the best of the best. Because right now, there's going to be an immense amount of consolidation. You just can't have these many players long term. Too many people, and that has to come down. I mean, just look at the number of manufacturers for anything, automobiles, cereal, whatever it is. You don't have 400 tomato growers in any state anywhere. It's just at 7,000 in Oklahoma is ridiculous. So long term, look at strategic partnerships, think about an exit strategy, and just know eventually you have an ability to either merge or be acquired. And if you don't, and you try to be that Larry's Handy Mart or World 7-Elevens, you're going to find out really, really quickly that your margins are thin and that you're working all the time. And it's just not probably the ideal scenario you want. I've seen it, seen people that are working all day long, and they thought they were going to make some money, and it just wasn't there for them. So you can try to avoid that by, again, utilizing that first mover advantage and trying to establish something worth acquiring. Go out, build out some partnerships, find people in other areas and regions that are willing to collaborate with you, and then market that entity, that group, that all have the same kind of philosophy, the same idea of exit strategies. So you're all on the same page. So when that opportunity comes, you all can exit collectively together, and then start that new venture, or whatever that 2.0 is. You can kind of come back and create craft cannabis and create some cultivars that people actually want. But right now, this big cannabis is not going to stop for anybody. It's going to steamroll pretty much everybody in their way. There will be people that survive, but they're going to have to shift prices, margins, something, lay people, whatever. They're not going to be able to survive without compromising something. And that's going to be on behalf of marketing budgets or employee benefits or something, because they just aren't going to be able to keep pace with the scale. Even though the quality is way better, it's just too early. That's my opinion. That's where I'm seeing things going. We've already seen that kind of 420 has peaked. It peaked before the pandemic. The pandemic forced a lot of people to make a lot of discounts in the store. And as a result, this year, it was really bad numbers, like not even close to what a normal Friday would have been. Really, really bad all across the board, multiple stores. I've asked people, and things are changing. The dynamics, the e-commerce, the sales, the technology, everything is changing what we thought we knew about cannabis post-pandemic. And so if you want to be in the industry, you need to understand where things are going, how things were, where we're at now, in order to get a full picture of where you need to be. So that's going to include a lot of things, including but not limited to an ideal team, getting the right target market, understanding your price and where to sell it, knowing how to invest the money you have made, knowing how to get money when you need it, how to automate and scale and stay in business, where to go in order to get the best discounts and opportunities, and how to partner and exit the right way. I think if you follow this 8-part cannabis series, you may end up being a business that lives longer than most. If you're able to pivot to stay relevant, you're able to know and understand all of these elements, you might just have a chance.
With that, we're going to roll this one up. I'm Josh Kincaid. This is The Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out. Don't forget to smash that like button on your way out and check out these other videos that we've got.